and welcome to Markets Forward. This is the budget special. I'm Ritu Singh. Joining me today is my colleague Manglam Balu. We have an exciting lineup of top market voices to analyze the budget verdict. But first up, let's dive right into the market action for the day after the budget. Manglam, what a volatile session, started fully in the red, and a green screen is what we ended with. The sentiment seems to have turned.
The sentiment seems to have turned, particularly in the last hour of trade or so, because the first half was extremely volatile. We opened mildly in the green. Thereafter, there was a big gash towards that, 24,500 thereabouts, closer to yesterday's low. Thereafter, there was one move. The intraday chart of the Nifty actually tells you the story of the day, where we went up, we went down, we went up again, we went down again, and thereafter we ended higher, and much higher than that 25,000 mark. There you have it. So that was basically the story of the day. Around that 11 o'clock mark is where we were closer to that 24,600 mark than we are to the 25,100 mark where we ended. We're still not out of the woods, not out of danger, still below the 200-day moving average on the frontline index. But the broader markets did well. We had more number of stocks advance towards the end of trade. And the Nifty Bank still is underperforming, just, testing levels of below 58,000 and then closing above that 58,600 mark. But again, it's still 1/3% higher as against the frontline index, which is about 1% higher.
It is, and even specific names pulling up the Nifty, whether that was Reliance, L&T, ICICI Bank, HDFC Bank, all of them did their bit, to really turn things around in the last couple of hours of trade. But we also spoke with market veterans through the course of the day to understand the budget, its impact on the sentiments. Ridham Desai, Samir Arora, Naren and Neelkanth Mishra weighed in on what worked and what did not. Take a look.
Now, the government has chosen to do the opposite. It has estimated its income rather conservatively. You can see this line by line. It's expecting a 10% growth in corporate tax revenue, which I think is super conservative. It's actually budgeting for pretty aggressive growth in expenditure. And therefore, I would say that it has erred on the side of caution. And the likelihood is, as the year progresses, it may find itself beating its estimates, which actually augurs well for all the markets, which is equity, bond, and currency. So that's the first comment. The second comment, which I made earlier today, today and in fact over the past few days, is that in my 35 years of doing markets, actually slightly more than that, I am sensing right now, and I'm relying this purely on memory, so take it with a pinch of salt. Is this the biggest disconnect I'm seeing between the macro and the market? So the macro actually looks pretty good. I mean, look at the auto data that came out yesterday. It would suggest that we are in a recovery in growth. If you look at macro stability, things are actually quite benign. And in contrast, if you look at markets, whether it's the equity market, the bond market, or the currency market, they seem to be suggesting that India has some big problem on its hand. So this disconnect, I think, is certainly something to ponder over. Markets don't go wrong that often. But this time around, I'm quite convinced that the markets have underestimated what India is up to. So I think that's the second comment. And coming back to the overall comment on the budget, I think the budget actually addressed quite a few strategic issues, whether it's with respect to AI, whether it's with respect to services, or the focus on defense. I think it nailed quite a few issues, and in fact, even simplification of taxation. So in my view, this was a very good budget. In both senses, in the sense that it doesn't overextend or overestimate things, and in the extent of the policy that it's delivering, which is a continuation of what we've seen over the past few months. Now to your question about FPIs. So clearly we are from the capital market, so we get very narrowly focused on what is the government doing about markets. And the last thing we want is them to do something that spooks the market. So unfortunately, the STT increase has spooked the market. And this is a little harder for people to understand, those who are not in the market. I mean, why would a 15,000 crore increase in a tax cause such big damage to market capitalization? And the reason is very simple. For those who are not in the market, is that the markets function on sentiment first, and then fundamentals. And the sentiment was already weak. going into the budget. In fact, if you look at India's relative performance in the 30 days in the run-up to the budget, this was the worst ever that India had. And it was going to be so hard to disappoint the market, but the budget managed to do so despite it being such an excellent budget with a little small change. So, that's the nature of markets. Markets will go through this and may probably, when fundamentals assert themselves more strongly, this will be forgotten and over. But on your comment with respect to FPIs, I mean, it's something that I've been talking about for a while now. And actually, it came through in the budget. So our suggestion was that the definition of FPIs should be liberalized, and that has happened. So persons residing outside India, PROIs, are now in a position to buy a lot more stock in India than they could do before. Now, the next thing, which I think was a very important line in the finance minister's speech, and I'm not sure whether that's got enough airtime, was with respect to the modification to FEMA on non-debt instruments. So you can say non-debt is not very different from equities. And I would be eagerly waiting for the RBI's announcement on this, because it's okay to allow foreign investors to buy. The process has still been onerous for them. And if FEMA delivers a simplified process, then I think we've opened up the Indian markets to a completely different capital pool, relative to history. Historically, this market has attracted largely emerging market pools and to some extent global pool, but not HNI and not other pools of capital, which is what this budget has done. So yeah, it's a material change, but it has to be seen together with the proposed modification to FEMA, which I think we'll learn in the course of the next few days.
But today at least, markets seem to be settled. So day one after the budget, we aren't seeing that overhang of STT play out in the markets. Ridham, afternoon, and thanks so much for joining in. Rima here. So data center sector has emerged as the big winner of this budget with tax holidays till 2047. Share your views on what has transpired, what's happened in the budget, and actionable investable ideas basis this.
I think India is probably one of the most attractive places on the planet now to set up data centers. This tax holiday has really sweetened it. So we've already seen tens of billions of dollars being announced, and I won't be surprised if these amounts go up materially in the next few months. The budget looks at the supply side issues quite intently, and we're talking about semiconductors, we're talking about rare earth. So all of these things go into the whole AI trade. It's certainly taken care of the energy side. There's a lot of incentives that have been rolled out, and I'm very bullish on the energy sector. So, and of course, skills. Do not underestimate the importance of the safe harbor for IT services.
The challenge that I see, I mean, I think the STT issue is more for controlling speculation, as the finance minister also mentioned in the press conference. But the challenge, I think, is on the financing side. So you've seen that the 10-year bond yields have now gone up to 6.76. And clearly the financing plan for the deficit and the fact that the government's overall conservative approach to forecasts, so taking a 10% nominal GDP growth, taking tax to GDP only marginally higher, I think they can do better on taxes. Perhaps on the financing side, they've gone excessively conservative. And that's something that is having the opposite effect of what the fiscal discipline and sticking to the fiscal consolidation path should have achieved. So there's clearly some work to be done there. I think 10-year yields should be, I think, closer to 6 and not 6.76 is my view, because the liquidity conditions are such that banks are having to borrow 12-month money at 7%. Yields have been going up, and now with the gross borrowing coming up higher than what markets had expected, has again started to push up. So that's something that I would say is perhaps the only niggle. Maybe you could have also expected a better plan for privatization and disinvestment. But again, I mean, some of those things can happen during the course of the year.
Neelkanth, are you saying the government has been very conservative with the revenue collection targets, and that is actually not That's not the right way to look at it. So you're telling markets don't be worried because they've been too conservative and they'll collect more. Is that what you're saying?
Part of it is that, but I think the bigger issue has been on the financing of the deficit. So, for example, if you take small saving schemes, and I know we are getting a bit nerdy here.
No, because Naren just talked about exactly that, the small saving schemes. I mean, it's been very healthy, but what they've accounted for is very conservative. Yeah, go on, sorry, Neelkanth.
Yeah, exactly. So, sorry, I only caught the last bit of Naren's talk. So the first 9 months, there is a 32% increase in collections. But the full year number for FY26 is down 13%. So I think 4.2 lakh crores in FY25 falling to 3.73 or something like that in FY26. Whereas in the first 9 months, you've seen a 32% increase. Now, a large part of the small savings inflow actually happen in the month of March. So perhaps they know more than what we do, though it seems unlikely given that there's been no dramatic change in the policy or the rates on small saving schemes. And on that low base, they're expecting a 4% increase next year. Now, this is very good and conservative because, frankly, predicting some of these things is hard. But this means that you are expecting, 1 lakh crore, 1.2 lakh crores less on small saving schemes, and potentially even 1.5 lakh crores less than the small saving schemes than what you're likely to get. And this is possibly why your cash balances, meaning government cash balances, which can go out of the banking system.
But you expect the yields to inch lower. It will be addressed from the current 6.76. You said ideally it should be 6%. And if it stays around the 6.5%, 6.6%, what are the broader implications? Will it hurt the growth? Will it impact the kind of earnings expectation the market has, investors have from the market?
Absolutely. So, if you look, the fact that the core inflation measures, ex gold and silver, plus, say if you take median inflation, those measures are at record lows. There is clearly evidence that there is significant slack in the economy. Now, the economic survey talks about 7% growth being the trend growth, which I think is the right measure, that we have been at that level for a while. And if you assume 7% growth and assume that the starting point is say FY18 or 19, we are 10% below where we would have been if COVID had not happened. And so therefore there's significant slack in the labor market, in the economy. Now there's significant output gap. There are only two ways to close an output gap. One is fiscal, the other is monetary. Now on the fiscal side, I think prudently the government is sticking to its roadmap, which means that interest rates and costs of borrowing should come down. So it will take much longer if we are not able to cause this transmission.
Well, S. Naren is Executive Director and CIO, ICICI Prudential AMC. He's one of the largest money managers in the country. Naren, good morning. Great to have you with us here. And I should say congratulations first up on that. I mean, I think investors are going to be happy. You're going to be around at the helm of things. So it was good to see that. Naren, what's your sense? The budget reaction and what will the market do from here? Lots of opinion that we've gotten, pragmatic, etc. But this STT thing maybe is just kind of, for now at least, overshadowed everything.
I was involved in stockbroking from 94 to 2004. Somehow I've not seen retail investors make money in derivatives. But the way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. Because if you look at the fiscal deficit, it is in order. Overall macro is in order. And government is thinking, how can, one of the biggest challenges for India is it was not seen as a country which is connected to AI. So they did come up with this data center tax concession to propel investments in data centers. We've always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction. But the market is looking at an area where only retail has lost in the last 25, 30 years. And if you increase taxes there and reduce volumes there, it's beneficial for retail. They have not touched STT on cash equities. So that is the challenge at this point of time. How to convince the market that actually this is a positive step for most retail investors, bad step for HFT traders and those kind of people. So how to convince that is one of the challenges, I guess, for the government.
It's one of the reasons that FIs have given a pass to India despite the expected earnings recovery is that even though in India, say FY27, we get about a 13% kind of earnings growth, you're still getting a 15 to 20% earnings growth expected, say, in emerging markets or even in the broader US markets. So those markets are still attractive. Now that even the budget has not given any concessions to FIs, what is the expected FI behavior to your mind this year?
So why did they invest in earlier years like 2024? So what happens is, we've seen in those years, they were not willing to invest in Brazil and China, which was very cheap at that point of time. And they were overweight India at that point of time. Our view is that, recent past performance does play a role in deciding where money goes. And if you look at India from a 1 decade view, I think India represents still one of the best structural stories. The challenge for us is particularly people who have been fund managers for long as the markets have not been cheap. If by chance the markets have been cheap, we would want to give a thumping the table buy on equity because everything else is in favor except valuations. And that is the challenge we've been facing. And that's why it's boring for us to tell every time, do asset allocation, do asset allocation. But that's what we have been forced to do only on account of valuations. But today, valuations across the world is not cheap. And that is why I do agree in the very near term, maybe there are AI stocks which will deliver very good earnings growth. But neither are other markets cheap at this point of time. So I would say that to be maximum underweight today in India at this point of time means that at some point of time in the future, they will have to think of buying. So that is a positive in my opinion.
The big risk for market is this AI thing bursting whenever it happens, right? Any thought, any updated view on that? Are we, will we see a shakeout at some point? Are we there yet?
Yeah, clearly, when you compared AI and precious metals, I thought precious metals had become much more euphoric than AI. If you look at AI, at least many of the stocks had stopped going up in a parabolic move. So, between AI and precious metals, we had to, we always look for the most dangerous areas. So the most dangerous areas in the last 1 month turned out to be precious metal. It is not that AI is cheap. I think AI has still got to go through a correction, but AI is not at this point of time in bubble. It may be extreme valuation, but at least it is not a bubble. And I would say that there is a good room for a meaningful correction in global equity markets. But how much knowledge do I have when I make this statement is something I ask myself. But if I just do simple calculations like market cap to GDP, I think there is scope for a meaningful correction, but we are not experts. And therefore, we believe that if the global equity markets correct, our view is yes. And if they do, I think India should outperform at that point of time. But there is a risk of a global equity market correction in the next 2 years. When it will happen, again, we don't know. It will be nice to know if we could correctly time it, but we wouldn't know.
Samir Arora is with us, founder and fund manager at Helios Capital. Samir joined us yesterday morning as soon as the finance minister budget speech ended. Samir and I sort of, posted that later last night, and really lots of comments, mostly thanking you to kind of sort of that you expressed what a lot of people are feeling. So any changes in the mood, thought process?
So
as I said, budget plus one.
let me explain for everybody's benefit.
Yeah.
So the point is, I think that the market participants and even the government feel that the market is just dependent on other sectors. So, when the, say, Mahindra and Mahindra CEO will come, he will talk about how the budget has helped the auto sector. But if in that budget, the help had gone to quick commerce sector, then the Mahindra and Mahindra CEO will say it's an okay budget, bad budget, whatever. The point is that we should look, and the government should look, and the system should look at the market as an independent sector also. In addition to saying because it helps data centers, it'll help the market. Because the market has many other factors, for example, taxes, FII taxes, liquidity, and relative this market versus that market. And so when the market is bad, like say today the textile sector is bad because of US tariffs, then the government says we are going to help the these textile companies with whatever, either cheaper loans, this, that. Currently, in the last 1 year, the Indian market has done very badly. And look at it in dollar terms, or more, look at it in euro terms, Swiss terms, because maybe X percent, 20, 30, whatever percent of the people might be coming from Europe and Switzerland, and they would have lost more than 20% on currency alone. So in that context, it should be at least accepted, recognized, maybe 5 lines should be said that, we are keeping a watch on this, and if it goes beyond a point, we will do. In that context, to put a charge, even if it is to squeeze liquidity by the way, if you see me on Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. The FPI guys or FII guys can put 5 billion in a month or in a week, and all they need is a little bit of recognition of their role and the fact that this money is easier to get. It funds Indian promoters. All it needs is fairness and a little bit of recognition of the role of stock market per se itself.
We played out that Revenue Secretary soundbite, right? And Shireen spoke with him.
Yeah.
That you just played it before we came to you. What he said is this is not to raise revenue. This is to.
I saw it.
Yeah,
I saw it.
This is to.
But the fact that now you got 15,000 crores, so please give it to the other side.
I am asking you whether this is actually even, because it seems like it's kind of, they're taking a stance. So it's ideological in that sense, that we want to curb speculation.
I don't myself, know. By the way, I myself used to say it, that it is too much. I agree.
Okay.
But you see, you need it in a certain environment.
Yeah.
You can't have it in an environment where India is massively underperforming, and primarily because the stock market is doing badly relatively and all that, and FPIs are leaving. You need a certain time for that. And also, this gives the impression that the market itself is not of importance. And I am saying that the market should be seen as a separate this thing, and I am the self-appointed representative of the market or of FPIs. But I'm saying the market can solve so many problems. The market is like an ad. It's an ad of the country. If the world sees that the market is down and the currency is down, without looking, they think that the budget is bad, which is what I keep recommending this book, The Halo Effect. The price also determines many things. And then, therefore, you will postpone things saying, no, that means nothing has changed. Everything changes. And why should we be, and it's some of it you may say, we are overvalued and all, which I don't believe too much. Some of it is because we have extra taxes, extra STT, etc., which in bad time comes out. In good times, nobody cares because it absorbs, the fact that the performance.
You don't mind paying a little bit more. Yeah, you don't mind
paying. But you say it doesn't matter because overall. So what I'm saying is it is for these times. And even now you don't have to do it. But please say it that, we are watching this closely and we are going to track it and, we are not letting it. Everything helps. But at that time to do an STT, is like saying we don't care, and that is the negative part. Not so much that whether what is happening in EMS companies or what is happening in defense, obviously. And by the way, we still own all those. By the way, even yesterday, of course, before the budget started, we bought a lot for our FPI account. Some of these which actually did okay. But anyway, so the point is, nobody's walking away. So this idea, oh, if you don't like it, go to another country. If you don't like it, how come the market went up in 24? That's not the point.